Chart timeframes. When analyzing the financial markets, we're always going to be looking at multiple chart timeframes. Why do we do this? Well, let me give you an example. When I was little, I broke my arm 3 times. I know, clumsy kid, right? When I went to the doctor to really see if I had broken my arm or not, the doctor always took a bunch of x-rays from multiple different angles. He didn't just take one picture from one angle. If he did it that way, he may have missed a key piece of information or may have diagnosed me without actually seeing what was going on. We're going to be doing the same thing in the financial markets. We need to look at multiple time frames to be able to understand the overall market environment. We don't want to look at just one angle or look at just one picture to see what's really going on. We're looking to see what this stock or market is doing and where it's likely to go. And to do that, we look at more than just one time frame. The time frames that you're going to be using will depend on your trading purpose. The beautiful thing is that Online Trading Academy's core strategy is equally applicable to any market, any asset class, whether that be stocks, futures, forex, or options. It's also time frame independent, which means that it can apply to any time frame, whether that be an hourly, a daily, a weekly, a monthly, or anything in between. It works for any objective that we have in the markets. We're going to be using a minimum of 3 timeframes when planning our trades. And each of these timeframes has its own purpose or function to our overall analysis of the markets. The first time frame we'll use is the higher time frame. You're going to see this written often as HTF, and the higher time frame will be used to assess what we call the curve. More on the curve in another lesson. Next, we'll go to our lower time frame, or LTF, to identify our supply and our demand zones. From there, we'll go to the intermediate time frame, or ITF, to assess the trend. Looking at these 3 time frames will give us the full picture we need to see to make an informed decision about whether we'd like to buy or sell, about how we wish to engage the financial markets. Depending on your trading purpose, this will determine the time frames that you're using. If you're a monthly income trader, your trades will be lasting for up to a few months. As a weekly income trader, your trades are going to be lasting for up to a few weeks. As a daily income trader, these trades will last for up to a few days. And as an hourly income trader, the trades can be expected to last for up to a few hours. Generally, the longer the trade lasts or the longer the trade duration, the higher the time frames used. On the flip side, the shorter the duration of the trade or the shorter that these trades last, the smaller the time frames used. These first 2, monthly income and weekly income, are generally considered for the long-term trading, whereas daily income and hourly income are considered for short-term trading.